2022 has been a rough year for the stock market. Inflation, rising interest rates, a bear market, and fear of an incoming recession troubled investors. In fact, earlier this year, the U.S. stock market had a total decline of 20.5%. This meant that the market had entered a bear market, defined as losses exceeding 20%. Historically, a recession has occurred after a bear market on 83% of occasions. Predicting the market's performance this year seemed nearly impossible, with high interest rates and supply shortages causing many classic strategies investors counted on previously to fail. Typically, fixed income investment prices are thought to hold up better when stocks decline, but this year, bonds were hit hard by rising interest rates. The 10-year Treasury note had its worst performance in 234 years. With these issues having created such large losses, it's no surprise that 90% of investors expect the U.S. to enter a recession before the end of 2023. On the bright side, analysts predict that a deep recession like 2007 to 2009 would be less likely. Several factors leave the U.S. in a better position to face a recession. The U.S. GDP grew at a 2.6 annual rate in the most recent quarter. Strong corporate and consumer balance sheets continue to buffer economic weakness. Unemployment remains near historic lows, and American consumers have over $1 trillion of stimulus-derived savings, as well as their lowest household debt in 2 decades. Whether we have a recession in 2023 or not, we know that the end of the year historically tends to be a good time for the stock market. In fact, from the day after Christmas through the second trading session of the new year, the Dow has recorded an average gain of 1.5%, rising in 77% of the years since 1896. This period has been jokingly referred to as the Santa Claus Rally. Here's to hoping Santa Claus visits the market this year.